Dollar cost averaging.
Oh yeah, you want to know one of the easiest ways to become a millionaire? I did it by investing just $500 a month. Stick around, and I'll show you how smart investors build serious wealth without timing the market. In this video, you'll learn what dollar cost averaging actually is, how it protects you from buying high and panicking low, when it works best and when it might not, and how to get started with just $10. All right, enough talk. Let's dive into it. What is dollar cost averaging? Dollar cost averaging, or DCA, is when you invest the same amount of money at regular intervals no matter what the market is doing. For example, you invest $100 into the same asset every month. It's been around since the early 20th century, but it gained traction thanks to Benjamin Graham, Warren Buffett's mentor, who called it one of the most rational strategies for average investors. Lesson number 1. Consistency over time.
How it works and why it's powerful.
Here's how it works. When prices are high, you buy fewer shares. When prices drop, your same dollars buy more. Over time, you average out your cost per share and avoid dumping all your money at a market peak. Lesson number 2. DCA lets you buy more when price is low, buy less when price is high. Good. When DCA works best? DCA works best when you're investing for the long haul, in ETFs, index funds, or diversified portfolios. It shines in volatile markets, where prices swing and timing is tough. But here's the nuance. Dollar cost averaging doesn't protect you from falling prices in the short term. But like most long-term strategies, it's built on the idea that markets will rise over time. DCA is about risk control, not max returns. Lesson number 3. You probably heard this one before, but time in the market beats timing the market. You don't need a crystal ball, just consistency. That's how real money grows. So, how do you start using DCA today? These days, nearly every brokerage lets you automate investing. Set a recurring deposit, weekly, bi-weekly, or monthly. Pick an asset or portfolio and let it ride. Even $10 a week can compound over time into something serious. Lesson number 4. Find a broker, set it, forget it, let it grow. There it is. So here's what we covered today. Dollar cost averaging is a simple strategy that builds wealth steadily over time. It lowers emotional risk by taking the guesswork out of when to invest. It works best when you stay consistent, especially in volatile markets. And you can easily start today, even with just a few bucks. Always remember, time in the market beats timing the market. Now, let's bring it home. Can $500 a month really make you a millionaire? Yep. If you invest consistently and earn around 10% a year, which is close to what the S&P 500 has done over time, you'll end up with over $1 million in 30 years. No hype, no guesswork, just a smart, steady play called dollar cost averaging. Stick to the plan, ride the waves. And that's how you turn small moves into $1 million future. Like and subscribe for more wisdom from your favorite bull buddy. And hey, share this with that one friend who keeps throwing their life savings at whatever TikTok says is the next big thing. We gotta help them. See you next time on Bulls, Bears, and Money. Ciao for now, compadres.